So I'm starting the session now. So a very good evening, everyone. So let's start the session. Today's topic of discussion is going to be chapter number 3, theory base of accounting. Okay. I don't have any presentation for this. I will be discussing from T.S. Grewal. Everyone is having T.S. Grewal now. Anyone not having, please raise your hand. Anyone not having T.S. Grewal? Sanjana. What happened, Sanjana? Why even after 2 weeks?
Sir, I have ordered in the Flipkart, but it not yet received to my hand, sir.
Okay. So when it is expected?
Sir, the Flipkart tells it will be expected by 17.
17. So that means before our next class, you should be having it, I believe.
Yes, sir. Sure, sir.
Okay, good. Akshit, what
Thank you,
about
sir.
you?
Sir, I'm getting mine tomorrow, sir.
Getting it tomorrow. Okay, good, guys. Because I spend a lot of time in taking a photo, then converting it to PDF. And all of you should know that I am a full-time working professional. And teaching is only my part-time passion. I'm not full-time into teaching, actually. So for me, it takes a lot of time converting into PDF and all those stuffs. So it's better that everyone can keep it handy with them during the class. And whatever we discuss, keep the book handy with you and follow the book along with me. And today I will be displaying T.S. Grewal in the screen, and we'll be discussing each and every concept in theory base of accounting. A very fundamental chapter. A chapter again, see, when I discussed about accounting term, I told that that chapter is something, all the accounting term, till the time you are dealing with accountancy, those terms will always be, throughout your life, those terms will always be there with you. Clear? So we discussed about assets, liability, income, expenses, sales, purchases, sales return, purchase return, drawings, capital, all those things lifelong is going to stay with you. So similarly, what we are going to discuss in today's class, theory base of accounting, a very interesting topic, as in we will be discussing a lot of accounting, fundamental accounting principles, and lot of principles which are again going to stay with you for long. Okay. I will try to keep it very engaging, very interactive, as I always try to. And any questions, feel free to ask me during the session. Clear, guys? Okay, with this, let's start the thing. I think I have a new student today. Who is that new student? Yash. Yash, can you turn on the camera, please? Everyone, please turn on the camera. Let me at least see everyone, all of you actually. All the students, please turn on the camera. Yes, you are there in the class. Yogeshwaran,
Sir,
Yainian.
sir, my camera is on.
Okay, good.
Yes,
I can
sir.
see you now. Okay, good. Fine. So let's start the session, guys. Theory base of accounting. I will share my screen and we'll keep it interactive throughout the session. Guys, stop me wherever you are not able to understand or follow me. Okay. Can you see my screen, guys?
Yes, sir.
Yes, sir.
Okay. So theory base of accounting. In this, what we will be learning? Just 1 second. Okay. So in this, what we'll be learning? We'll be learning fundamental accounting assumptions. We'll be learning accounting principles. Okay. Then this topic is a very high level topic, not relevant at your level. It is relevant at CA inter level, but a very high level overview we will be just discussing about this topic. Means this entire topic on accounting standard is something which is not relevant for either the 11th standard kids, neither the 12th standard kids, neither the CA foundation kids actually. It's only relevant at a CA interlevel. So this is a very high level overview. But apart from this, other topics are very, very important. We'll be discussing this. Okay. Now, three important terms are there. Whenever we prepare accounts, we have three important fundamental assumptions, fundamental accounting assumptions. One is going concern, second is consistency, and third is accrual. That means these are all fundamental assumptions based on which an accounting is done. First one is going concern. Anyone who can tell me what do you mean by going concern? I'm not expecting a correct answer because I will explain to you. But anyone who has a knowledge on going concern.
Sir, the enterprise or the business is assumed to be going for more than 1 year or many more years.
Okay. See, first thing you have to understand, it is a fundamental accounting assumption. Fundamental accounting assumption. That means whenever we prepare accounts, we always assume, it is taken as an assumption itself, okay, that the business is a going concern. I told businessman and business are separate, right? Business is a separate entity. Whenever I prepare the accounts, or whenever any business they prepare the account, they always assume that the business is a going concern. What does it mean? It means that the business will be there tomorrow, will be there day after tomorrow, will be there after 10 years, will be there after 20 years, will be there after 30 years. That means the life of the business is indefinite. It's a fundamental assumption. Whenever I record a business transaction, for example, if we record a transaction, any transaction that we record in the business, we record thinking that the business is going to be there forever. Clear? We don't record a transaction thinking that business will, tomorrow my business will not be there. Always it is assumed that the business is a going concern. Always it is assumed that business is a going concern, but there are situations when business may have to forcefully wind up or close. That time, this assumption will not be valid anymore. Then the accounts are prepared assuming it is not a going concern. Accounts are prepared factually knowing that it is not a going concern. That's a different concept. The entire 11th and 12th that we will be discussing, we will be always be, or it's a fundamental assumption. It is always assumed. See, nobody has to tell the business is going concern. It is a fundamental assumption. By default, it is assumed that the business is a going concern. That means any transaction that is recorded in the books of account is recorded thinking that the business is going to be there forever. Am I clear? It is always assumed. It's a fundamental accounting assumption. You don't have to, no one has to mention that. It is always assumed that the business is a going concern. First and foremost important thing. Okay. Okay, before that, there are few things which I will discuss. Okay, I directly came into this concept of going concern. Okay, going concern assumption prescribes that transactions should be recorded and reported on the basis that business shall continue for a foreseeable period and there is no intention to close down the business and or scale down its operation significantly. Okay, so it is always assumed that the business will continue for a foreseeable future. Foreseeable future means for a very long period the business is going to continue and there is no intention to close the business immediately. Clear? Okay, before that, I will just take a minute to just discuss. Okay. See, there is something called generally accepted accounting principles. We call it as GAAP. what is generally accepted accounting principle? It is a set of rules. It is a set of rules, concepts, and guidelines that define the accounting parameter and constant within which the accounting operates. That means to do an accounting, there has to be some rules, right? If I have to play cricket, I am also a part-time cricketer. On weekends, my only thing is either I play cricket or I teach. That is the only thing that I do. So when we play any sport, there are certain rules, right? Within which there are certain rules and framework within which a sport has to be played. Similarly, when we do an accounting, there are certain framework which we have to follow. Like there has to be a format of P&L, there has to be a format of balance sheet, there should be something known as debit, something known as credit. What should be debited, what should be credited? There has to be certain rules, right? What is an income, what is an expense? There has to be certain rules actually. So generally accepted accounting principles are set of rules. Okay, are set of rules or code of conduct, absolutely right. Okay. Now, everyone would have heard about chartered accountants, CA. There is a institute called Institute of Chartered Accountants of India who delivers that course and who offers that degree. So Institute of Chartered Accountants in India, they are the only institute in India who can conduct CA exams and who can give the qualification CA degree to anyone who qualifies that course. And this is the highest level of body for accountancy in India. And they also has lot of prescribed accounting standards. See, it is the highest level of body of accountancy in India, Institute of Chartered Accountants of India. All the CAs, they are a member of the Institute of Chartered Accountants of India. So as an institute or as a supreme body of accountancy, they have a lot of accounting standards. They have a lot of accounting standards which they have defined. Accounting standards are nothing but a regulation or a rule by which you have to account multiple things. Yeah, yesterday we were discussing about fixed assets, right? Day before yesterday. I told you there is a concept called property, plant and equipment, which when I take classes for CA Inter, I discuss that particular concept for around 4 to 6 hours. That 4 to 6 hours, why it takes? Because Institute of Chartered Accountants has defined how property, plant and equipment should be valued, how property, plant and equipment should be capitalized, when it should be capitalized, everything is given. So they have given a prescribed format or prescribed guidelines under which a certain transaction has to be treated. Clear? So Institute of Chartered Accountants has issued accounting standards. Accounting standards. Why they have issued accounting standard? They have issued accounting standards so that everyone who does the accounting for fixed assets, they follow the accounting standards. That means everyone will be following a particular standard based on which an accounting has to be done. There are close to 32 standards they have given on multiple topics they have given. Clear? So those things are not relevant to you. Meaning and nature of accounting principles. See, now there are accounting concept is there, accounting convention is there. Okay. What is accounting principle? Accounting principles are the rules followed universally for recording financial transaction. See, whether it is India, whether it is US, whether it is UK, whether it is Singapore, there are certain accounting principles which are there, which has to be followed when we do an accounting. Clear? In India, we follow Indian accounting standards, or previously it was accounting standards. In UK, we follow international financial reporting standards. In Singapore, we follow Singapore financial, SFRS they call it. In US, we follow US GAAP. In Dubai, we follow IFRS. So every country has their own accounting framework. India has Indian accounting standards, which is almost equivalent to international financial reporting standards. See, many of the countries, they have adopted IFRS. Many of the countries like UAE, UK, they have adopted International Financial Reporting Standard. But India has not adopted. India has adopted Indian accounting standards because India wants to distinguish itself separately. India is one of the highest intellectual countries when it comes to accountancy, because CA course is not easy. So the intellectual capacity of India is very high. So what they did is, instead of copying in International Financial Reporting Standard, they have their own Indian accounting standards, which is, to your surprise, it is 95% copy of IFRS. But still they don't call it as IFRS. They call it as International Financial Report. They have copied everything from IFRS, named it differently. Okay. Previously, we had accounting standards. That was different, actually. That was different. But when accounting standards got converted to Indian accounting standards, they copied International Financial Reporting Standard. 95 to 99%, it is similar to International Financial Reporting Standard, but still proudly we call it as Indian accounting standards. What are accounting standards? It is a set of rules and regulation. It is a set of rules and regulation to capture a particular kind of transactions. At your level, it is too early for you to understand. I told it's a CA inter-level topic. So I will just give a very high level view of what is an accounting standard. Okay. So there are certain principled accounting principles are the basic or fundamental proposition generally accepted as set of accounting principles. Okay. Now there are two things: accounting concepts. Accounting concepts are fundamental proposition based on which transactions are recorded in the books of accounts. Accounting convention is accounting concepts are the rules or the assumptions based on which we account a financial transaction. Accounting convention is something which is historically being done. If we are following that practice, that is called as a convention. Clear? Okay. Now let us get into the main part of this chapter. Okay, features of accounting principle, it's are all theory. Accounting principles are man-made. Accounting principles are flexible. From one business to another, see, there may be two accounting principles for the same transaction. Like for depreciation, there is an accounting principle called straight line. There is an accounting principle called written down value. One company can choose straight line, another company can choose written down value. Okay, so based on what policy they want to adopt, they can adopt actually. Okay, two schools can have two different policies, right? Similarly, two companies can also have two different policies. Some will tell that on Wednesday someone has to come on white uniform. Some will tell on Tuesday you have to come in white uniform. Some will tell that this particular day will be a sports day. So every school will have different rules to follow. Similarly, every company can decide the accounting principle they want to choose. Clear? Accounting principles are generally accepted. These are all okay. Whenever we adopt an accounting standard, it should be based on relevance. Accounting principles are objective. That means they are not influenced by the personal bias, and it can be only adopted if it is feasible. First, whenever, see, on what basis we have to adopt an accounting standard. First of all, it should be relevant. If I am choosing one principle, it should be relevant for that particular business. Second is, it has to be objective. That means as an entrepreneur, I should not choose my accounting principle just because I want higher profits. There are two methods of depreciation. I should not choose or change my method of depreciation to get a higher profit. I should be unbiased when choosing an accounting principle. Third one is, it should be feasible. I should be in a position to adopt that accounting principle. Okay, so these are all very high level understanding. You can just go through it. I will come to the main discussion, what is intended for this class. Now, this is most important. Fundamental accounting assumption. Three fundamental accounting assumptions which you have to remember. One is going concern. Second one is what? second one is consistency, and third one is accrual assumption. I will take you through one by one. Going concern assumption. Most important. Whenever we record any transaction in the books of account, we record the transactions thinking that my business will be there forever. I don't record a transaction thinking that my business will not be there tomorrow. For example, if I purchase a fixed asset, if I purchase a computer today, the life of the computer or laptop will be minimum 3 to 5 years. So I record the transaction in my books of account as a fixed asset, thinking that I'm going to continue the business forever. If I purchase a building, the building will be there for minimum 30 to 40 years or 50 years. Okay. So I record the transaction as a fixed asset, thinking that I'm going to continue this business forever. If I don't think that business will continue forever, then what will I do with the building which is purchased today? That is of no use, right? If I am thinking that tomorrow I am going to close my business, the building purchased today will be of no use. Clear? So I cannot record it as a... So any transaction which is recorded in the books of account, it is always assumed that the business is going to continue forever. Very, very fundamental business assumption. It is called as going concern. Any doubt? Let us read the language from the book. Going concern assumption prescribes that transaction should be recorded and reported, that the business should continue for a foreseeable period. For a foreseeable period means for a very long period. For a very long period, the business should continue. Okay, let me close the screen. It is automatically coming. Okay, for a foreseeable period, and there is no intention to close the business or scale down its operation. It is because of this concept that distinction is made between capital expenditure that will give benefit for a long period and revenue expenditure. I was giving an example of building. If I don't think the business will continue for indefinite period, I have purchased a building for my business for 1 crore rupees. If I think that tomorrow I'm going to close the business, the entire 1 crore will become an expense for me, right? But it is not. The building is going to be there in the business for 20 years, 30 years, 50 years. So what we do is we treat it as a capital expenditure. Non-current assets. What was the definition of non-current asset we discussed in the last chapter? Anything which is going to give me benefit for more than 12 months. Clear? So the capitalization of an asset is decided because the business is treated as a going concern. Any doubt? Are we good? Yes, you are able to follow the class? Okay.
Sir,
Yes.
so going concept assumption means that we record the account assuming that the business will go on.
Yes, absolutely. That is what exactly I am telling. Any accounting is done on the assumption, on the fundamental assumption that business is a going concern. That means my business is going to be there forever. It's a fundamental assumption. Okay. No one has to tell you. The owner will not tell you, auditor will not tell you. It is always, whenever an accountant records a transaction, he will always keep in mind that business is a going concern. It's a fundamental business assumption. Clear? Any doubt?
No, sir.
Let's move to the next cons. For example, a machinery purchase for 1,10,000. Its life is 10 years. Its life is 10 years. 1 lakh is written off. So residual value is 10,000. Okay. Machinery purchase for 1,10,000. Residual value is scrap value. At the end of 10 years, if I want to sell it, I will get 10,000 rupees. So what do? We depreciate 1,10,000 minus 10,000 divided by number of years. Number of years is 10. So 1 lakh divided by 10. Every year I have to depreciate 10,000 rupees. Okay. It is based on the what is the concept behind this? I am thinking that I know that my business is going to be there for more than 10 years. So I can easily depreciate this asset for 10 years. Clear? How this calculation has come, don't worry about that calculation. That is not the objective. That we will learn in the chapter number 15, depreciation. In that chapter, we will learn how to compute depreciation. Clear? This is just an example quoted. Okay. So if I don't assume that the business is going concern, entire 1,10,000 that I have spent for that, entire 1,10,000 I should charge it off as an expense, which is not correct accounting treatment. Clear? Any doubt, guys? Okay, what is the residual value in the example? It is nothing but the scrap value. After 10 years, if I want to sell the asset, I will get 10,000 rupees. That is called the residual value. Not relevant for discussion at this point. I told when we go to the chapter of depreciation, chapter number 15, you will understand this concept in detail. For now, just understand the machine will be there or the building will be there in the company for 10 years. The 10-year life, we can assume the building can be there for 10 years, 20 years or 30 years because the business is a going concern. The business is a going concern. Clear? Any doubt? Next, consistency assumption. Okay. Another very fundamental assumption. See, these three are fundamental assumption. Second one is consistency. See, there are various methods of recording depreciation. One is straight line method. Another is written down value method. What is straight line? What is written down value? Don't worry about it. Okay. Now, one business can choose straight line method. Another business can choose written down value. Okay. Now, once my company has adopted straight line method, can I change next year to written down value? Answer is no. There are certain circumstances which we can change, but the general answer is no, I cannot change. Why I cannot change? Because of this particular fundamental accounting assumption. Once an accounting principle is applied, year on year, we have to apply the same accounting principle so that our profit and loss account shows consistent results, actually shows consistent results. See, by changing the accounting principle, what will happen? For example, if I am using straight line, now I think that, okay, if I take written down value, this year I can show higher profits. By changing the method, if a higher profit is coming, businessman will automatically think, boss, this year let me go to written down value. Maybe I can show higher profits. This fundamental accounting assumption is stopping that. It is telling, boss, last year you have chosen written down value. This year also you have to choose written down value. Just because straight line method is giving you higher profit, you cannot switch. That is not allowed. You have to be consistent. It is written. WRITTEN, not written. Okay.
Sir, what is the meaning of that term?
Yeah, see, as I mentioned, this is a concept which has to be dealt in chapter number 15, written down value. Okay. For now, there may be few terms which you may not be understanding. These are two different methods of calculating depreciation. One method is, okay, I will give you an example. One method is, I purchase an asset for 1 lakh. Life of the asset is 10 years. So every year, how much I have to depreciate? 1 lakh divided by 10, it is 10,000 rupees. Okay, simple. This is called straight line method. Every year, 10,000 rupees depreciation will go to your profit and loss account. This is called straight line method. Another method is written down value method at the rate of 10%. So first year, 1 lakh into 10%, 10,000 depreciation. So 1 lakh minus 10,000, how much is the value of the asset remaining? 90,000. Next year, same 10,000 will not be depreciated. On the 90,000, I will put 10%, which will be 9,000. So first year 10,000, second year 9,000, then 8,100, like that. It will keep on changing in written down value. See, that is not relevant to you now. Okay, we have a separate chapter for discussing this. Okay, so what I am telling, if I am using straight line, I cannot change to written down value because my fundamental accounting assumption do not allow me. It is telling that consistency. Whatever I adopted last year, I should be adopting the same accounting policy. There are few exceptions when I can change. That is not part of our discussion. Clear? Any doubt, guys? Clear? Consistency. According to consistency assumption, accounting practices once selected and adopted should be applied consistently year after year. Should be applied consistently year after year. That means if I choose WDV, if I choose WDV, I have to choose this for first year, second year, third year, and so on. I have to continuously choose this accounting principle forever. Clear? Any doubt? Aditya, clear or not clear?
Clear, sir, no doubt.
Okay. The concept helps in. So consistency concept is important because equally acceptable alternative accounting practices exist. Okay. So why consistency is important? Otherwise, 1 year I will choose straight line. Next year I will choose WDV. Then I will again choose straight line. Then another year I will choose WDV. So my intention will be whichever method is giving me higher profit, I will try to choose that, which is not allowed. Which is not allowed. It is telling once on the first year you can decide whether you want WDV or straight line. Whether you want written down or straight line, on the year 1 you can decide. And once you have decided, every year you have to follow the same thing. Did I get stuck, guys? Okay, clear? Any doubt?
No, sir.
So first one is going concern, second one is consistency, and the third one is the most important, which is accrual assumption. Okay, accrual assumption, it has to get registered in your mind. What does accrual assumption mean? For a moment, I will stop sharing my screen. Let me see more faces now. Guys, turn on the camera. Very interesting discussion. Accrual, going concern, everyone is clear? Going concern means business is going to be there forever. Consistency, once I decide an accounting principle, I have to apply that accounting principle year on year. I cannot change. I'm not allowed to change. I can choose. On year 1, I can choose whether I want written down or straight line. Once I have decided, I cannot change every year. Clear? These two are clear, guys? These are fundamental accounting assumption. That means by default, a business is assumed to adopt going concern. Second one is consistency, and the third one is accrual. What is accrual? What is accrual? Any idea? Any guesses?
It is the assumption where we assume that the transaction should be recorded irrespective of the cash received or not.
Okay. It is correct. I will not tell it is wrong. It is correct partially. Okay. Let me give you a lot of examples in this. Okay. Accrual concept. Okay. Very important concept, guys. Even today when we do accounting in our office, I work for an MNC. Whether it's an MNC or a private limited company or a small company, accrual concept is very, very important. What does it mean? In a financial year starting from April to March, how many months are there? Everyone is speaking in mute. I have to understand sign language now.
12 months.
12 months. In a year, there are 12 months. Can it happen that expenses are recorded for 15 months, income is recorded for 12 months? Is it a right way of preparing accounts?
No,
No.
sir.
Opposite. Can expenses be recorded for 15 months and income be recorded for 12 months? Is it correct approach? No.
No, sir.
Okay. Now, let me take one example. I have taken a premises on rent. I have taken a premises on rent for 1 lakh rupees per month. April to February, my financial position was good. I was able to pay the rent for 1 lakh rupees into 11 months. I was able to pay the rent. In the month of March 2026, I was running the business in the same premises, but I was not able to pay the rent for the month of March 2026. I was not able to pay the rent for March 2026. Now I have to prepare my financial statement for the period April to March. 11 months rent is paid, 1 month rent is not paid. 11-month rent is 1 lakh into 11 is 11 lakh. 11 lakh rent paid in cash. 1 lakh rent I am not able to pay, but I use the premises for entire 12 months. My question to all of you now. My expenses for rent for the entire year, is it 11 lakh or is it 12 lakhs?
Sir, we
My
will
rent-
include outstanding expense
Sir,
and we'll
12
write it
lakhs.
12 lakhs.
I paid only 11 lakhs. I paid only 11 lakhs. Can I record 12 lakhs as expenses?
Sir, is it not an outstanding rent?
I am asking you a question. How much should I record? Whether I should record 11 lakhs or I should record 12 lakhs as expenses?
12 lakhs.
12 lakhs. I got one answer as 12 lakhs. Anyone else?
Sir, 12 lakhs.
12 lakhs. Two answers for 12 lakhs. Anyone else? Sorry?
12 lakhs.
12 lakhs. Three are telling 12 lakhs. Anyone else? Sorry?
12 lakhs.
12 lakhs. Four answers for 12 lakhs. Yash, what is your answer?
Sir, mine also 12 lakhs.
12 lakhs. So I have all intelligent students in my class then. Makes my job easy. All of you are absolutely right. Let me explain the concept behind it now. See, I have taken the premises on rent for 12 months. I paid rent for 11 months. 1 lakh into 11 lakhs I have paid. 12th month, I have used the premises, right? That means I have enjoyed the services. I have enjoyed the services. I have used the premises. I have enjoyed the services. That means I am now liable to pay this 1 lakh to my landlord. Correct? Only thing is payment has not happened. Just because payment has not happened, does it mean that I did not enjoy the premises? No. So when I have to prepare my profit and loss account for 12 months, I have to show 11 lakh rupees paid in cash plus 1 lakh rupees of outstanding expenses. In the last class, we discussed about outstanding expenses, right? So 11 lakh rupees paid in cash plus outstanding rent of 1 lakh, my total expenses will become 12 lakhs. My total expense will become 12 lakhs. So whenever we do an accounting, we do an accounting based on accrual concept. Here I am not using cash concept. But if I am following cash basis of accounting, which is our next chapter is cash and accrual basis of accounting. In the next chapter, two methods are discussed: cash basis of accounting and accrual basis of accounting. If I am following cash basis of accounting, I will record 11 lakhs as expense. But when I follow accrual base of accounting, I have to take 11 lakh of expenses plus 1 lakh of outstanding. Total expenses will become how much? 12 lakhs. This is called as accrual basis of accounting. The moment I enjoy the services or moment I avail the services, I cannot deny paying that expenses. Any doubt? Another example. Another example. I run a business. I have employees in my business. Same level. There are 2 employees. I pay each 50,000 salary. Or take only 1 employee. I have only 1 employee. I pay 20,000 as salary. I paid for 11 months. 12th month, the March month, again, I am having some financial problem. I could not pay salary to him. So 20,000 into 11 is 2,20,000. In the month of March, I am not able to pay. So whether the salary for the month of March, is it an expense for me or not? It is an expense. It will be treated as outstanding expenses. So 20,000 into 11 will be recorded under salary. Another 20,000 will be added to salary in the name of outstanding expenses. My total expense will become 2,20,000 plus 20,000, 2,40,000. And my P&L account will show expenses of 2,40,000. Even though I have not paid 20,000, that will be shown as a liability and also as an expense. Clear? Yes, cash basis do not include accruals, do not include something which we have not. Okay. Cash basis, Yogeshwaran is having a network problem for a bad network. Okay, you will just keep following me. Otherwise, this class is recorded. Today's class also I will be uploading, I believe. If the recording has come properly, I will be uploading it. You can see the recording if you missed any of this thing. Clear? So 20,000 into 11, 2,20,000 is the amount which is paid in cash, plus 20,000 which is not paid in cash. My expenses in the P&L will be 2,40,000. That is called accrual concept of accounting. Any doubt, guys? Any doubt? I will take one more example. Yesterday we discussed about insurance, right? I gave an example of insurance. My accounting year is April to March. In the month of January, see, generally insurance is always taken for 12 months. In the month of January 2026, I took an insurance policy with an annual premium of 1,20,000. For 12 months, my premium is 1,20,000. This is for 12 months. For which 12 months? Jan 26 to December 2026. Clear? Now, okay, let me open an Excel file. I'm not sharing my screen, right?
No, sir.
Okay, let me share my screen, guys. Can you see my screen?
Yes, sir.
Okay. So
Yes,
I was
sir.
talking about insurance premium, 1,20,000 of insurance premium. Period is January 2026 to December 2026. Out of this, Jan to March 2026, 3 months comes in this financial year. April 2026 to December 2026, 9 months comes in next financial year. 9 months comes in next financial year. So all of you are aware that we prepare our books of accounts for April to March. We prepare our books of accounts for April to March. So for the period April to March, April 25 to March 2026, this 1,20,000 is per year. That is for 12 months. For 1 month, how much it will be? 10,000 rupees per month. How many months are coming in the period of April to March, how many months are coming, guys?
12.
April to March. I have to start from January, February, March. Only 3 months are coming in this financial year, 9 months are coming in next financial year. So can I record entire 1,20,000 as expenses for this year? Not possible. I can record only 3 months. So what will happen? It will go in 2 different financial year. 3 months, 10,000 multiplied by 3, 30,000 will go in this financial year, and 10,000 multiplied by 9, 90,000 will go in next financial year. This is called as accrual concept. That means I can only record the expenses for the period. I can only record the expenses for the period for which I am preparing my accounts. I cannot record a 12-month expenses in this year because entire 12 months is not falling in this financial year. Out of the 12 months, only 3 months is falling in this financial year, right? Are you getting the concept, guys? Only 3 months is falling in this financial year, so I can record only for 3 months. The remaining 90,000 will be treated as prepaid expenses. So we had a concept called outstanding expenses, right? Similarly, this 90,000 will become prepaid. This 30,000 will be expense in the P&L account. Okay, for now it is enough to understand. Prepaid and outstanding is dealt in very detail in the second last chapter of this book. Okay, for now just understand accrual concept. By accrual concept, we can only record income and expenses related to that period. Clear? I cannot record expenses pertaining to next financial year in this financial year. That is called as accrual concept. Clear? Am I clear, guys? Okay. Expenses are recognized as expenses. Expenses are recognized as expenses in the accounting period in which the revenue is related. That means my revenue and expenses. See, similar revenue also. Revenue and expenses both should be related to same period. If revenue is from April to March, my expenses should also be for April to March. I cannot have 15 months revenue and 12 months of expenses. Not possible. If revenue is recorded for April to March, my expenses should also be for April to March. Clear? Revenue should be for 12 months. Expenses should also be for 12 months for the same period. In US, they follow Jan to December. In India, we follow April to March. So in US, if they are preparing their accounts for Jan to December, their revenue and expenses should be for Jan to December. In India, we follow April to March. That means my revenue should also be for April to March and expense should also be for April to March. Whether I pay it or not is not meant necessary because we follow accrual. Payment is secondary. My income, even if I make a credit sale, see, I made a sales from January to February in cash basis. In March, I made a credit sale of 1 lakh rupees. So whatever credit sale I made, that also is my sale, has to be recorded as my sale because I follow accrual basis of accounting. Clear? Any doubt? Whether I receive cash or not is not necessary. If it pertains to April to March, then it will be a sale for my books of accounts. Clear? Any doubt, guys? Very, very, very important concept, guys. Accrual concept. Any doubt in this concept? Any doubt to anyone? So I gave an example of outstanding salary. I paid for 11 months. I did not pay for 1 month. So my salary will be still considered for 12 months because I have utilized the services of my employee. I paid rent for 11 months. I did not pay rent for the 12th month. Still, I will be recording expenses for 12 months because I have used this premises for 12 months. Clear? Clear, guys? Yes, are you following the class? Sanjana, clear? Yugeshwaran,
Yes,
Aditya,
sir.
clear?
Yes, sir.
Yes, sir. Yes, sir.
Sir,
Fantastic, guys. Very, very important discussion, guys. So 3 fundamental assumptions: going concern, consistency, and accrual. These are all fundamental. By default, the company has to follow. There is no choice. Clear? Okay, we'll move to the next concept now. RSM company sells good to VSN company on 27th February. Guys, 27th February, one sale has happened. 15,000 on credit for 12 months. On 27th February, a sale has happened on a credit sale. The sale, the cash for this will be received in April because I am giving 2 months credit. Whether this sale will be recorded in February or it should be recorded in April, which month it should be recorded? Can you unmute yourself? A sale has happened, a credit sale has happened in the month of February. 2 months credit period is given. That means the debtors will pay me after 2 months. Should I record the sales in the month of February or should I record the sales in the month of April?
Sir,
So
February.
in the month of February.
February, yes. Because the sale has already taken place in the month of February. Whether I receive the cash in the month of April is not relevant here. It will be recorded, the sale will be recorded in the month of February because it pertains to previous financial year, not the subsequent financial year. Clear? Any doubt, guys? Okay. Now, there are other accounting principles which are equally important. Now, we will discuss about other accounting principle. Fundamental accounting principle, most important. Going concern, consistency and accrual. There are other accounting principles which are equally important. Let's discuss, understand that one by one. Any doubts so far?
No, sir.
No doubt? Okay.
No doubt, sir.
Yes. Who has a doubt?
No doubt, sir.
No doubt, sir. Okay. Fine. Next is business entity principle. This I don't have to explain much. Business entity principle means business is separate, owner is separate. Whenever we record a transaction, Ram started business with capital of 1 lakh. Ram started business with capital of 1 lakh. The capital that Ram is contributing into the business, the capital which Ram is contributing into the business, Ram is treated separately, business is treated separately. The capital is called as what? Capital is called as what? We discussed in the last class. Capital is called as what? Internal liability. Business has to pay back this capital to Ram. Whenever the business is wound up, whenever the business is getting closed, the business has to pay back this capital to Ram. It is called as an internal liability. That means Ram is a separate, business is separate. Whatever transaction that we record in the books, we record it from the point of view of Ram or from the point of view of business? From the point of view of business.
Business, sir.
That is called as business entity concept. Clear? Ram can be an owner, that is fine. But all the transactions are recorded from the point of view of business, not from the point of view of Ram. Clear? This is called as business entity concept. Any doubt, guys? We have discussed this in detail over the last 2 sessions. Clear? According to business entity concept, the transaction is recorded in the books of account from the point of view of business. Example, Amit started business and introduced 1 lakh by check. So that means it is his capital. It is his capital. Okay. So thus a transaction is recorded in the firm from the firm's point of view. Business entity principle is applicable to all enterprise, be it a business or not. It's applicable to everyone. A private limited company, partnership, sole proprietorship, it is applicable to all kind of business. Any doubt? Clear? So going concern, consistency, accrual, fundamental accounting assumption. Next is other accounting assumption. First thing that we learned is business entity concept. Clear? What is the next one? Money measurement principle. If you remember the definition of accounting, the first thing that we mentioned is it has to be a financial transaction. Identifying, then measuring. First one is identification, second step was measuring. So we can record only those transactions which can be measured in terms of money. My employee got ill or he is having fever. Is it a business transaction? Managing director of the company, today is the birthday of managing director of the company. Is it a financial transaction? No. So we can only record something which can be measured in terms of money and which is a financial transaction. This is called as money measurement principle. According to money measurement principle, transaction and event can be measured in money terms are recorded. Only which can be measured in terms of money can be recorded. If I cannot measure in terms of money, I cannot record happiness. I cannot record I am angry. Those things and all cannot be recorded. Emotions cannot be recorded. Only something which can be recorded in terms of money can be recorded. Which can be measured in terms of money can be recorded. Clear? Any doubt, guys? Easy? Good so far? Okay. Next one. Accounting period principle. When I discussed about accrual, I already covered this. In accrual, what I told, income and expenses has to be for the same accounting period. Did I tell that? Okay. This principle also tells the same. Accounting period means if I am preparing my books of account for April to March, my income should also be for April to March. My expense should also be for April to March. If I am a US based entity, I prepare my accounts for January to December. My income should be for January to December. My expense should also be for January to December. For them, so whether it is India or US, principle remains the same. They are telling if it is January to December income, expenses should also be January to December. If April to March is your income, your expenses should also be April to March. Clear? Clear, guys? So income and expenses should be for the same accounting period. Okay. According to the accounting period principle, life of the enterprise broken into smaller period of 12 months known as accounting period. See, why we have broken down into 12 months? Why we have broken down into 12 months? If I don't break down into 12 months, see, your academic year is also broken down into 12 months, right? You are in 11th standard now. From 1st standard to 12th standard, can they give a cumulative degree to you after 12th standard? They cannot, right? Every year they have to measure your performance. First standard what you did, second standard what you did, third standard what you did. Similarly, business also, they cannot prepare their accounts for 10 years. Right? Every year the business has to know their performance, right? So that is why the period is broken down into a period of 12 months. Every 12 months, the business has to get their accounts audited. Every 12 months, the business has to get their accounts audited. They have to prepare the profit and loss account, balance sheet for after every 12 months. And they have that gives them a power to measure their performance, to see how much profit they have earned, what is their assets, what is their liabilities. So everything they can measure. So accounting period is generally in India, it is a period of 12 months from April to March. In US, it is a period of 12 months from Jan to December. Clear? Any doubt? So a period of 12 months is called as an accounting period. Clear? Any doubt? Okay, next. An accounting period is the interval of time after the end of which profit and loss account, balance sheet and everything is prepared. This is what I was telling. After 12 months, an entity will prepare the profit and loss account and balance sheet, just to see whether this year they were profitable or not. Clear? Are you following me, guys? Can I have some? Can I have
Yes,
someone
sir.
speaking? Danya, you're following Yogeshwar and Yash.
Yes, sir.
Yes, sir.
Fantastic, guys. Good, good, good. Full disclosure principle. Full disclosure principle means, I will give an example. When you go to a doctor, for a checkup, do you tell him 50% facts, or you disclose 100% facts to him?
100.
Why?
100%.
If you have fever, you will tell you have fever. If you have cold, you tell you have cold. If you are having any other symptoms, if you have body pain, you tell you have body pain. So you disclose everything what you're feeling, you disclose to the doctor. Why you disclose everything to the doctor?
So that,
So that
the doctor have that full clarity on.
Yeah, full clarity. Similarly, in a financial statement, whenever we prepare a financial statement, we have to give complete disclosure of our financial position. We should not hide anything. We should not mislead. Full disclosure means give transparent and full disclosure to anyone who is reading the financial statement. Who reads the financial statement? Owners, management, shareholders, bank, public, government authorities. Anyone who reads the financial statement, they should have enough information by reading the financial statement. We have to give a full disclosure in the financial statement. Clear?
Sir,
According to full
one doubt.
I will come to your doubt. According to full disclosure principle, disclosure should be made of items required under law and those which are material. What are the conditions? Whatever is required under law and whatever is material has to be disclosed. Whatever is required by law. If it is not required by law, you need not disclose. But if there is a law which asks you to disclose, then you should not hide that. Clear? Second, material. What is material? There is a separate discussion on material. I will come to that discussion later. Yeah, someone was having a question at this point.
Sir, what if we didn't disclose everything?
That means you are manipulating the financial statement.
So what is the consequences, repercussions?
Consequences is it can lead to fraud. It can lead to what you call misleading information to the public. Okay. The consequences is if you are not being fair and transparent and later a scam like Satyam scam or something happens, then there are serious consequences of that. Okay.
Like legally.
Yeah, legally, if it is done with a fraudulent intent, then legal measures can also be taken. But if it is only what you call ignorance or something, it depends on with what intention it has been done, whether it has been done with an intention to do a fraud or something. Okay.
Thank you, sir. Yeah.
Okay. So full disclosure is important. Whatever is required as per law has to be disclosed, and something which is material. See, there is a word which we will be often using called material transactions. Material transaction. This word is very frequently used by chartered accountants or someone who is pursuing CA. They frequently use this word material transaction. What is material transaction? I will take a very layman example to you. I will stop sharing for a moment. Okay. A company like Infosys, there is a stationery purchase for 10,000 rupees in a company like Infosys. 10,000 rupees of stationery purchase in a company like Infosys. Now, because of some reason, the transaction was not recorded in their books of accounts. Maybe someone would not have given the invoice to the accountant to account. The transaction got missed to be recorded. For a company like Infosys, which deals in millions and billions of dollars, whether this transaction of 10,000 rupees, if it is not recorded, will it change their financial position? Will it change anything It is just like 1 paisa or 10 paisa for them.
Sir, it will, but not too much.
It will not impact at all. Actually, it is just 0.00000001% of their entire value. They deal in million and billions of dollars. 10,000 rupees is not material for them. Okay, but imagine a small stationery shop in your area. If they miss a transaction of 10,000, their entire turnover itself is 1 lakh. A transaction of 10,000, if it is missed, that means it is the P&L account and balance sheet that they would have drawn, that may be entirely misleading also. Someone who is making a 20,000 rupees profit, if they omit a 10,000 rupees of transaction, financial statement may become misleading. Clear? So materiality means non-disclosure of which may lead to wrong decisions being taken from the users of financial statement. That means for Infosys, not disclosing this it will not impact anyone. It will not impact the banker. It will not impact the government. It will not impact the management. It will not impact anyone. So non-disclosure of 10,000 rupees for Infosys is immaterial, but disclosure of 10,000 rupees for a small trader, it is material. So materiality means if I am not disclosing a particular transaction, whether I am giving a misleading information to anyone, that is called as materiality. Clear? Understood? Materiality means if I am not giving proper information to someone, whether the person who is reading the financial statement will get misled. If it gets misled, that means the transaction is material. If we do not get misled, that means the transaction is not material. Clear? So now I will share my screen again. So in full disclosure, what it is told? In full disclosure, what it is told? They have to disclose everything which is required as per law and everything which is material. Clear? Everything which is material in nature has to be disclosed. Clear? Now the next concept is materiality. According to materiality principle, an item or disclosure is material if it can influence the decision of the user. So for the 10,000 rupees was material for a small trader because it will influence the decision of the person who is using his financial statement, right? It will mislead the person. It will mislead the person using the financial statement of a trader if he forgets to record 10,000 rupees. But in case of Infosys, it will not mislead. For Infosys, it is immaterial, but for the same trader, it is material. Are you getting the point, guys? For Infosys, maybe 1 crore may be material. If they don't show a transaction of 1 crore, their financial statement may be misreported or misleading. For Infosys, the materiality level may be 1 crore, or maybe 10 lakhs, or maybe 5 lakhs, or maybe 1 lakh. Clear? So the materiality, the level of materiality will differ from company to company. Clear? If Infosys do not report a transaction of 1 crore, it may have some small impact. See, 1 crore is also not anything for Infosys. They deal in billions of dollars. But I'm just giving an example. Maybe 1 crore may be material to someone who is using their financial statement. Clear? So the materiality depends from person to person. So materiality is something, non-disclosure of an item. What is the wording used? An item or disclosure is material if it can influence the decision of the user. 10,000 rupees was material in case of a trader because it influenced the decision of the person using the financial statement of trader. 10,000 rupees was immaterial for Infosys because it is not influencing the decision of the user. Are you getting it, guys? Clear? That is the concept of materiality. Very, very important concept, guys. Not at your level, but this wordings, if any one of you are planning to pursue chartered accountancy, you will come across this word very, very often during audits. At CA inter level, or whenever you go for articleship or internship in chartered accountancy, this wording will be very, very common. On a daily basis, you'll be using this word material. Clear? For now, this level of knowledge is enough for you. Clear? Any doubt? An item may be material for one enterprise, but may not be material for another. This is what I was discussing. 10,000 rupees, immaterial for Infosys, material for another person. Clear? Prudence or conservatism principle. Again, very beautiful concept. Prudence or conservatism principle. I will again stop my sharing. I like discussing more actually. Prudence or conservatism principle. Okay, I'm left with 15 minutes now for the class. Let me see how much I have to cover. I think I will be in a position to cover it. Okay. Last 4 or 5 small topics only. Okay, prudence or conservatism principle. What does this tell you? This principle tells you to record all anticipated losses. All anticipated losses. I will explain the meaning with some examples. Don't worry. It tells you to record all anticipated losses, but don't record any anticipated gain. I will give 2 examples for this now. Okay. Yesterday we were discussing about credit sale. Remember? There is a 1 lakh rupees of credit sale which we have done to a customer, or we have done 10 lakh rupees of credit sales to 10 different customers, 1 lakh each. We have made 10 lakh rupees of credit sale to 10 different customers. 9 customers are very good. 1 customer is not financially sound. I have a doubt whether he will pay the money to me or not. Out of 10 lakh, 1 lakh is doubtful. I got this information in the month of January that there is some raid which has happened in that customer's office, some income tax department or some raid or some legal case which has happened. The financial position of the customer is not good. It is very unlikely, after I have followed him for the last 3 months, it is very unlikely that I am going to receive that 1 lakh. My total sales is 10 lakh. 1 lakh rupees is sitting with one customer in the form of debtors. I will not be able to recover that amount from him. 10 lakh rupees is sitting in my balance sheet in the form of debtors. Credit sales, because it's a credit sale, I can see 10 lakh rupees in my balance sheet. 9 lakh rupees, I'm very certain I will receive next month. Within 30 days, I will receive 9 lakh. 1 lakh rupees, I will never receive. Now, as an accountant, what you shall do? You know that this 1 lakh rupees will not come. So, this accounting principle tells you, if you anticipate a loss, record that loss. I know that this 1 lakh rupees is not going to come to me. That means it is going to become a loss to me, right? It is going to become a loss to me, right? This principle tells you, record that loss today itself. Record that loss today itself. Show it as bad debts. Yesterday we discussed the terminology bad debts. Record it as bad debts. Show it as a loss. So, in case of conservatism, it is asking you to record all anticipated losses. So this loss I have anticipated in the month of January itself. I don't have to wait till February, March or April to record this loss. The moment I know that I will not get this amount, this accounting principle tells you to record it immediately. Clear? That is called as recording of anticipated losses. Any doubt? Expected expenses and losses has to be recorded today itself. Clear? Now, but another side of this principle is, it is asking me not to record anticipated gain. It is telling, don't record any anticipated gains. I will give you one example. See, all this example that I'm giving you are all from my practical experience of 15 years of practical experiences. Your school teachers will not be sharing most of these examples. Okay. But once these examples get registered in your mind, you will never be forgetting any of these accounting principles. Clear? So anticipated losses, I gave an example that 1 lakh rupees one customer will not be able to pay. What I shall do, I have to record that as loss today in my books of accounts. Show 1 lakh rupees as loss today itself. Clear? Now there is a fire in my office. Okay, daily I am firing my office. Today again. Okay, there is a fire in my office. My laptop, not the one which I am currently taking classes, another laptop, assuming I have another laptop, because I have to take next week also your class, right? So I will fire another laptop. So another laptop of mine, which is of 1 lakh rupees, it caught fire. What I will do, I have an insurance. I filed for an insurance. I provided all the documents to the insurance company. I am expecting at least the insurance company will give me 80,000 rupees. I tell my accountant, boss, already my laptop is gone. You at least take this 80,000 rupees as income. I have now the laptop value is 80,000. I'm expecting 80,000 claim from my insurance company. I tell my accountant, boss, record this 80,000. That guy tells me, boss, only anticipated losses can be recorded. Anticipated gain cannot be recorded. He reminds me. I am telling boss, I will receive this. Accountant is telling, no, I cannot record it. You have not received this. Accountant is arguing with me. I am telling, record it, boss. 80,000 rupees. Let me at least show 80,000 as income in my books of accounts. Accountant is telling, no. And he is right. Because this accounting principle tells record all anticipated losses, but do not record any anticipated gain. He is telling, boss, you can record it. If you are getting this in the next month, you record it next month. Na? Why you want to record it today? Whenever you receive this gain, you record it then. Don't record it today. You wait for some time. After 1 month, you will get this money in your account. That time you record that. So in case of bad debt, my accountant told record the bad debt immediately, boss. In case of bad debt, my accountant told all anticipated losses has to be recorded. I told boss, I may get the money, I don't know. He's telling, no, you will not get it. It's a loss. Let's record it today itself. In case of anticipated loss, I recorded today. But in case of anticipated gain, my accountant is telling, record it whenever you receive it. Don't record it today because you have not received it today. How you can record an income today without receiving it? Clear? This principle is called, I will come to you. This principle is called prudence or conservatism principle. Conservatism, everyone knows the meaning of being conservative, right? Conservative means you should not be very aggressive actually. So be very soft. Take all expenses in your head, but don't take all anticipated gain in your head. Because that will distort the financial position. You will be showing some income which is not your income. It will become income tomorrow. Tomorrow you record it. Yes, Aditya.
Sir, this anticipated loss. If there is no loss, what will you do?
If there is no loss, be happy.
No,
Who likes a loss?
no, we recorded it right in that account record.
Yes. Okay. Very beautiful question actually. He's telling, I have anticipated it as a loss. I recorded it, but suddenly after 6 months, he got a lottery and his financial position changed. Overnight, he became a crorepati. So for him to give 1 lakh rupees was not difficult. After 6 months, when he met me, he told, boss, I got a lottery. This is your 1 lakh rupees. So what I will do, I will happily record it as income. I will happily record it as income when I receive it.
So, sir, so you would forget that the record is.
No, that loss is already recorded. Now, when I get that income, this loss was recorded in the previous year. That income will be recorded in the year in which I receive it. So that loss and this income will get cancelled.
So the loss is cut.
Yeah, loss is cut, but in 2 different accounting periods. If it is within the same financial year, well and good. If it is in different financial year, 1 year I will show a loss, another year I will show a gain.
Thank you, sir. Clear.
Very beautiful question actually. This is called bad debts recovered. The concept that you asked me is called bad debts recovered. A very beautiful concept. Okay. It is called bad debts recovered. Bad debts recovered is an income. Bad debts is a loss. And this surprises me with the level of detailing that you are understanding the concept actually. I'm really happy. Okay. This is a very advanced concept called bad debts recovered. Okay. So I recorded a loss called bad debt. After 6 months, he sees me in a supermarket and tell me, boss, I got a lottery. You take your 1 lakh back. I'm very happy. I record it as income. That is called as bad debt recovered. Clear? Yes. Anyone else has a question?
Sir, what does anticipated mean in that anticipated loss or
Anticipated means you are expecting something to happen. Anticipated means you are expecting something to happen. When you expect something to happen, which is more likely to happen, the probability of that happening is more. That means you have to record it as loss. Clear? Everything that I speak, see, I don't have T.S. Grewal handy with me now, or I'm not referring to any of the languages which is given in T.S. Grewal, but anything that I speak, you can relate with every single word that is given in T.S. Grewal book. Clear? Every single word in T.S. Grewal, you will be able to recall the discussions that I am having. And this concept should get absolutely registered in your mind. Any doubt? I will share my screen again, guys. Now let us see from T.S. Grewal point of view what it is given. Okay. According to prudence, this is called as prudence. Prudence means in English, the translation of prudence is
or conservatism principle.
Prudence in English is intelligent. Prudence or conservatism. Conservatism means something, anticipating something and doing it. Okay. Expected expenses and losses are provided, but do not account for expected incomes and profit. You have taken a lottery today. After 1 month only the result will come. Don't think that today you are a crorepati. Clear? Don't anticipate a loss income today. If there is a loss, account for that loss today. Clear? Any doubt? This is prudence. Now, next is, guys, don't mind me extending this class by another 5 to 10 minutes. I just have to cover 3 or 4 more concepts. Okay. Are you all enjoying the session?
Yes, sir.
Okay, that is important. See, it should not feel very heavy to you. It should not feel very heavy to you. I try to keep it as light as possible. And whenever I feel that the session is heavy, I will stop. Be rest assured that whenever I feel that it is getting heavy on you, I will stop the session. Okay. Bear with me for another 5 to 10 minutes. Fine. Okay, because once I get into a flow, I don't feel like stopping actually. I'm used to taking classes for 3 to 4 hours continuous. So 1.5 hours is too short for me. Fine. Thank you, guys. Thank you for all the support and for being patient all throughout. Let's get back. Now, the next is cost concept. See, this also we discussed in the last class. Historical cost. When did we discuss this? Anyone can tell me? When did we discuss historical cost?
When we were discussing about depreciation.
Depreciation. Maybe can you be more clear on that? Precise on that? When did we discuss this? I will give you an example. I purchased.
Sir, in the times of fixing assets, Which
Okay. Do you all remember that I purchased I discussed about purchasing a laptop during COVID time 2020? That
yes,
example?
sir. Yes, sir.
What is that example? Can anyone tell me? What was that example that I quoted? Okay. There is a laptop which I purchased in 2020 for 1 lakh rupees. See, all these are example. Okay. I'm just quoting example. You don't think that I have so many hundreds of laptop at home. I don't have. I have only one laptop. Okay. So in 2020, I purchased a laptop for 1 lakh rupees. Today, the market value of the laptop is 1.5 lakh. Whether in my books of account, the laptop will be recorded at 1 lakh less depreciation or at market value of 1.5 lakh today.
Sir, 1 lakh
Sir, 1 lakh, sir.
1 lakh. This is called as historical cost concept. Always when we do the accounting not from the market value point of view. We do the accounting on the date when the transaction was recorded. If I purchased in 2020 at rupees 1 lakh, in my books of accounts still it will be at 1 lakh, but less whatever depreciation that we have. This is called historical cost concept. Any doubt? So this entire concept is over with one example. Transactions are recorded at the price paid. Transactions are recorded at the price paid. Clear? Just one word. Transactions are recorded at the price paid. In 2020, I paid 1 lakh. So I will be recording that at 1 lakh only. Clear? Any doubt? Are we
Yes,
good
sir.
so far?
Yes, sir.
I'm happy that 15 students have joined today and all 15 are still here. Not even one have left. That means you are following the class. Good. Next one is matching principle or concept. This again we have discussed. When we discussed accounting period, when we discussed about accrual concept, we discussed this matching concept. Matching concept means if my expenses for 12 months, if my expenses for 12 months, my income should also be for 12 months. If I'm recording income for April to March, my expense should also be for April to March. If I'm recording my income for Jan to December, my expense should also be for Jan to December. This is called as matching concept. This we discussed in accounting period also. Similar example I gave in accounting period also. Accounting period is a period of 12 months. Income is also recorded for 12 months. Expense is also recorded for 12 months. Same thing I'm discussing here in another language called matching concept. And same thing I discussed in accrual concept also. Even though I paid the salary for 11 months, I hired that employee for 12 months. I have to record the salary for 12 months. That was accrual concept. Clear? All these are interrelated concepts, guys. Clear? Are you finding the connect between accrual, matching, and accounting period? All three are interrelated concepts because I'm using the same example in all the three. Clear? Any doubt? Okay. So this was matching period. According to matching period concept, expenses incurred to earn the revenue. Expenses incurred to earn the revenue should be recognized as expense in the year revenue is recognized. If I am recognizing the revenue in financial year 25-26, income should also belong to that period. My income cannot be of one financial year, expense cannot be from next financial year. It is not possible. If income is for April to March, my expenses should also be for April to March only. I cannot bring an April 2026 expenses in financial year 25-26. Not possible. Clear? Any doubt, guys? Next, dual aspect principle. Dual aspect principle we discussed lot of times. I told every transaction has a
Debit and credit.
debit and credit.
Twofold effects. Every
It is called-
transaction has a twofold effect.
Yes. Every transaction has a debit and credit. When Ram introduces capital into the business, it has a debit and credit. When Prasad purchases a laptop, it has a debit and credit. When I do a sale, it has a debit and credit. When Aditya purchases a building, it has a debit and a credit. When Danya does a sales, it has a debit and a credit. Clear? Every transaction has a debit and credit. That is called dual aspect principle. Any doubt? Only the last two, guys. Only the last two. Revenue recognition concept. According to revenue recognition concept, revenue should be recognized when right to receive is established. Right to receive is established. It's actually a very, in 11th, it is just discussed in half paragraph. There is a 100-page write-up on revenue recognition. When we go to CA Inter, it's a 6 to 7 hours of discussion in revenue recognition. Very, very important concept. For you to make it very simple, I will just tell you, revenue recognition is when I am entitled to receive an amount, I can record as revenue. In simple words, I am giving a service to you, or I will take a different example. You call a technician for installation of AC in your home. You call a technician for installation of AC in your home. He asks that, okay, I will come for installation, you have to give me 2,000 rupees. When he can demand that 2,000 rupees from you? When you call him, can it ask for 2,000 rupees?
After the installation.
After installation. That means his right to receive that amount, is established when? After he completes that service. So the moment he completes the service, you cannot say no to him. You cannot say I will not pay, because he has a right to receive that amount from you. That is the point. That is the point. After installation, he can show that as revenue in his books of accounts.
Sir, before that he could not demand, like,
He cannot demand, and it is not his revenue also, right? He has not given the service to you. Can he record the revenue in his books of
I
accounts?
will only work when you give rupees this much.
Yes. No. I am talking about, can he record a revenue in his books of accounts?
No, sir.
No.
That cannot be
He
done.
cannot record because he has not given the service. When he will record the service, after installation, he will call the owner. Boss, I have completed the installation. Owner will tell us, receive cash. What owner will be doing there? He will be recording. He will be generating an invoice. He will be generating an invoice in his office. That is the point he can record the revenue, not when he sends the technician. In case of goods, the moment the goods is handed over to you, you buy a TV, no installation required. The moment you collect the TV from the showroom, Saravana stores or Big Bazaar or any other electronic shop, they can record the revenue. Clear? The moment the TV is handed over to you, they can record the revenue. Clear? In case of goods, the moment the goods are handed over to you, it can be recorded as revenue. In case of service, whenever the service is completed, it can be recorded as revenue. Simple example, guys. Clear? But it's a very, very detailed discussion. I don't want to get into too much detailing. Very simply, I am just telling you in one word. Okay. According to revenue recognition, revenue can be recognized when the right to receive is established. It is to be noted that recognizing revenue and receipt of amount are separate. Okay, this and all okay. You can ignore it. The revenue can be recognized when the right to receive. In case of a installation of AC, the right to receive is after completion of service. In case of goods, it is the moment the goods are handed over to you, revenue can be recognized. Clear? Next one. Verifiable objective, the last concept. See, we discussed about money measurement concept, right? what is money measurement concept? That it should be capable of being measured in terms of money. In case of verifiable objective, yesterday we discussed about voucher, right? There were two kinds of voucher. One is source voucher, another is accounting voucher. So I am telling my accountant, boss, I purchased a sofa. I went to a furniture showroom. I purchased a sofa for rupees 25,000. I tell my accountant to record that sofa. Accountant is telling I will not record. He is asking me for invoice. He is asking me, give me the invoice first. How do I know that you have purchased the sofa? How do I know that you have purchased the sofa? Give me the invoice. Then I search my pocket, I find the invoice, I give the invoice to the accountant. That is called as verifiable objective. That is called as verifiable objective. I cannot make him record sofa just by saying that I purchased a sofa. He's telling, show me the evidence that you have purchased. Because business is separate, owner is separate. Business is asking me, show me the evidence. Then I take the invoice of sofa and give it to the accountant. Now the accountant is recording. This is called as verifiable objective. That means verifiable objective means it should have a source document. The source document can be an invoice, can be a receipt, can be a memo, anything. But there has to be a document proving that I purchased that sofa. Clear?
So sir, is this verifiable objective concept is like a proof?
Absolutely. We cannot record a transaction which never happened, right? The transaction should be verified. It should be based on evidence. I cannot record a transaction. I will stop presenting here. We cannot record a transaction which never happened, right? If I tell my accountant you record a sofa and I never purchased a sofa, can he record that? He is right in asking for an invoice for that. Because he has to verify whether it actually happened or not, right? That is called as verifiable objective. Any doubt, guys? With this, time is exactly 8:40. I extended only by 10 minutes. Okay. I covered this chapter entirely. There are few portions of the chapter still left, which are not significant, but I will cover before the next class. I will take 15-20 minutes to cover along with the next chapter. Okay. But whatever we discussed so far is only important and relevant for the entire chapter. First three fundamental assumptions. What are the three fundamental assumptions, guys? Everyone together. Three fundamental assumptions.
Accrual, consistency, going concern.
Going concern, accrual, and consistency. Remaining, we discussed about conservatism. We discussed about prudence concept, conservatism, and verifiable objective. We discussed about matching concept. We discussed about accounting period. We discussed about materiality. All these are also equally important, but those are all fundamental assumptions. Fundamental means no one has to tell you, that is always there in the business. Clear? Any doubt in today's class? Okay. Hope you were able to relate with all the practical examples being shared. You were able to understand it better. Okay. My only request to you is, before our next class, read it entirely. Chapter number 1, chapter number 2. Those who joined today or missed any of the classes, please see my recording. I have recorded the last 2 videos in YouTube. Please see that video. Let's ensure continuity in the class. And if you stay with me regular, I can ensure you that every concept will feel very easy to you. I can make the toughest of concept look very, very easy to you. Okay, none of the concept you will feel that it is tough to you. That is my assurance to you. Only my requirement is you have to stay with me throughout till February, and you have to, whatever we are discussing on Friday, revise on Saturday. Whatever we discuss on Saturday, revise on Sunday. And whatever we discuss on Sunday, you have time from Monday to Thursday. And if you just follow this, I will ensure accounts is made very easy to each one of you. Clear? Can we do that, guys? Fantastic. Yes, Yugeshwaran, you have a question?
Sir, away from the box, I have a question, sir. Can you explain about modern rules of accounting?
Modern rules of accounting. I will only go with my flow, guys. I will not go with the flow of. I have 11 different schools in my class. I will not go with what your school is covering. I will not go with that syllabus. I have to cover everything in detail. If I start following the school, what will happen is there will not be any difference between school and me. I can ensure that none of the 11 schools that you are representing would have discussed the concept in this much of detail. They would have spent 3 hours on accounting terms. They would have spent 1.5 hours on explaining this concept. I can bet that. Okay. So don't expect me to be running behind schools. That will be the last thing that I will do in my class.
Okay, sir.
Only one thing that I will ensure is by end of the entire 11th session, you will be on top of all the concepts. And you will be ahead of all your schools that you are representing. You will be, accounts will be very easy for all of you. That is one thing that I can ensure. Clear, guys? So modern rules, we will discuss whenever we discuss modern rule. You will understand it much better than what you have understood now. Clear?
Okay, sir.
Thank you, guys. It is 8:45 and have a great week ahead. I will see you. Next class will be on Friday at 6:55 p.m. Okay. This recording also will be uploaded.
Sir, which time, sir? Friday?
You tell me what is the time for Friday?
7 to 8:30.
7 to 8:30, but you should log in at
6:55.
6:45.
6:55. No compromise on being punctual. Fine. See you guys at 6:55 on
Thank
Friday.
you, sir.
Have a
Thanks,
great
sir.
week ahead, guys. Thank you. Bye.
Thanks,
Thank
sir.
you,
Bye.
sir.
Thank you. Thank you, guys.
Thank you, sir.
Thank you.
Bye. Thanks, sir.
Thank you. Thank you, guys. Thank you. Thank you. See you guys.